Once again, very good evening to all. In this part of webinar, we are going to discuss about how to match ITR with financials and AIS information that is available with the department and 26 AIS. In addition to this, what are the forms applicable, what are the types of forms available for filing ITR, and we are going to discuss about in depth of class 44, that is GST related expenditures which need to be reported in tax audit report. All are we are going to discuss in the following time. First, we will see choosing the correct form. There are total 7 forms available for filing income tax return. ITR 1 is applicable for individuals whose total income is less than 50 lakhs rupees. And ITR 2 is for individual who is not eligible to file ITR 1 and whose total income is more than 50 lakh and agriculture income is more than 5,000 need to file ITR 2. ITR 3 is for individual assessees who is having business income and not eligible to file ITR 1, 2 and 4. ITR 4 is generally for presumptive taxation, which means if assessee is opting for 44 AD or ADA, then assessee can go with filing of ITR 4. There are total number of pages is significantly reduced compared to ITR 3. ITR 5 is residual form. That is, ITR 5 is applicable for firm, LLP, cooperative societies and private trust and other assessees who has not exclusively ITR form has not been prescribed, then assessees need to file ITR 5. ITR 6 is for companies and ITR 6 is for all companies other than Section 8 companies. Section 8 companies, ITR 7 is applicable. ITR 7 is also applicable for trusts, including charitable and religious trusts. Then we will see what is annual information statement. This is a statement which is available to the income tax department, and this will provide the comprehensive information about the taxpayer. If any objective of AS is complete information that is available with the income tax department. And other objective of AS is to ensure the assessee to voluntarily comply with the provisions of income tax, that is offering correct income and expenditure and the computation of total income that need to be computed correctly. For that also, this is one of the objective for annual information statement, and this will prevent the non-compliance. If assessee omits to report any income or expenses, then income tax department will issue a notice stating that you have missed so-and-so income or expenses in your while filing your income tax return. That this will prevent the assessee to ensure proper compliance. And AS has been divided into 2 parts. Part A is a general information which contains name of the assessee, PAN number, Aadhaar number, which is masked Aadhaar number, date of birth or incorporation, mobile number, email address, and the address of the assessee has been given in the part A of the AAS. Part B of the AAS contains all the relevant information has been available with the department. That is, reporting entity need to report all the transactions to the income tax department. They will give reflect in our AAS. First information is TDS, TCS related information. If director has deducted the TDS or TCS, collected the TDS, then it will reflect in AAS only. This will TDS, TCS also reflected in 26 AAS also. We will see in further slides what is 26 AAS and difference between AAS and 26 AAS. All we will see in later point of time. Specified financial transactions information, which is dividend, cash deposit, or interest income. These all reported in SFT information. And payment of taxes. Payment of taxes like advance tax or self-assessment tax only reported in TAS only. So AS only. this is not going to report in 26 AS from the financial year 23-24 onwards. Information relating to demand and refund also reported in AS because this information already available with the department. That information will reported in AS. And other information such as GST turnover, GST purchases. Also, GST turnover is based on R3B and GST purchase based on our suppliers GSTR1. It will also get reflected in AS. This should be matched with our financials. We will discuss in a later point of time. And what is TAS? TAS is Taxpayer Information Summary. This TAS provides aggregated category-wise snapshot of the taxpayer's financial records. That is nothing but AAS category-wise summary will be separately given. That is TAS. It displays two key values for each information category. Say for example, turnover or GST purchases, dividend income or cash deposits, cash withdrawals. Everything can be reflected in TAS as a summarized manner, and it has two key values. That is, one is processed by system. That is, total summary of all transactions available in the AAS has been summarized and reflected in TAS. This will reflected after adjustments of any duplication entries, because if supplier corrects some data in GSTR1 or subsequent TDS corrections have been filed, then AAS reflects two times, but here it will summarize a single time and it will be reported here. And another key value is accepted by taxpayer or confirmed by the source, which means we need to provide our feedback to feedback in the AAS portal. That will automatically confirm, send the confirmation to the source who is reported that value. Say for example, if we take GSTR1, then it will automatically goes to supplier that whether this information is correct or not. If that information is based on GSTR1 of the supplier, then it cannot be, it again need to be given as feedback. And final values updated after considering the taxpayer, that is our feedback in the AAS portal. This will TAS will helps to quickly overview of summary of all transactions that is available with the department. Say for example, GST turnover and purchases, dividend, interest income, cash deposits, cash withdrawal, all are available with the department. So if this information is available, then we need to check with our books of accounts whether we have recorded the same transactions, all the transactions in our books or not. And Form 26 AS, that is tax statement, consolidated tax statement. It is issued by the income tax department. That it reflects all tax collected at source and tax deducted at source information based on director's tax filing statement. Director's tax filing statement. This will be available. And Form 26 AS includes TDS details, TCS details. This is also available in AS also. And details of refunds, this is also available in AAS. And TDS defaults, this is not available in the AAS. And TCS defaults, while we log in taxpayer portal, that is while we get into 26 AS portal, we get initial notification that we have so and so TDS defaults and TCS defaults. Please check if you have any TDS or TCS default to quick check immediately what are the defaults you have for the respective financial year. It will give summarized total demand outstanding TDS and TCS defaults. And tax audit report. Generally, audit means independent verification or examination. Tax audit means independent verification in compliance with Income Tax Act 1961. That is, a chartered accountant is the person who is responsible, as the person notified by the income tax to audit under Section 44AB of Income Tax Act to get the assessee's books of accounts audited. So if your books of accounts need to get audited, then it must be a chartered accountant, and he will file Form 3CA or 3CD, 3CA or 3CB, and along with the 3CD. So we will see in, later. The CA conducting tax audit is required to give his findings or observations and disallowance in 3CD in form of audit report. That is, in case of Form 3CA, audited chartered accountant need to give his observation or qualification in Form 3CA or 3CB, as the case may be. In both, 3CA is applicable for companies, generally companies, that is, assessees who all are subjected to audit under any other law. They need to go with 3CA, 3CD. If assessee is not subject to audit under any other law, then they need to go with 3CB, 3CD. That is, say for example, for individuals whose turnover exceeds 1 crore or 10 crore, as the case may be, then they need to then the chartered accountant need to file 3CB and 3CD. As I said, forms has been divided into 3CA, 3CB, and 3CD. 3CD must be annexed with the 3CA and 3CB, as the case may be. And we will directly get into the topic, matching the financials with ITR and AAS. This is a very crucial point while preparing income tax return or financial statement, as the case may be, because we need to verify the GST purchases and sales reported in sales that is already available with the department. Why it is important? Because sales reported in AS is as per GSTR 3B. So subsequently, we have corrected any amendment has been made, it will not reflected in AS. So we need proper reconciliation between GSTR 3B and books and AS data. Because if in case of any discrepancies, the income tax department, that is complaints portal, for AS, we need to go to complaints portal. So in the complaints portal, the notice will be issued to the taxpayer. We need to respond to that saying that we have adjusted so and so. That's why the total turnover has been showing this amount. Otherwise, the possibility of getting notice is very high. Income tax department may take scrutiny assessment proceedings. Because as I already said, the GST returns and financials and income tax, this three needs to be aligned. Income tax means our computation and our financials and GST returns. So these three all needs to be aligned. Otherwise, because GST department has signed MOA with the income tax department, they will share the data to the income tax department directly. So if misreporting may lead to trigger income tax notices as well, GST notices as well. So we need to be cautious in that part. Assessee need to ensure that income must be matched with financial statement. That is, income means income as per ITR. Say for example, some income, to say interest income. Interest income generally do not form part of revenue from operations. It will be disclosed under other income in the financial statement. If interest income received, it will not reflected in GST returns, because interest is not subject to GST. And this needs to be verified with the AS, which means if the person who is paying interest to us deducted TDS, it will reflect in AS. If not deducted TDS, it will not be reflected in AS. So we need to verify financials, which means books of accounts need to taken along with to be verified with the annual information statement, which is already available to the department. And purchases. We can verify party-wise purchase. based on GST number given to our supplier. If we have purchased any even for rupees 10 rupees, also it will reflect in annual information statement if the supplier is registered person and he correctly entered our GST number. And unregistered purchase must be in financials only. Unregistered purchase nowhere reported in the AAS portal or nowhere reported to income tax department. So we need to be cautious that unregistered purchases also to be included while preparing our computation, which means in our total income, the purchases need to be reduced, because while computing profit and loss account, the total income and expenses have been reduced. So we need to reconcile that total purchase includes unregistered purchases as well as registered purchases that will be reported in the AAS. And cash deposits and withdrawal, it must be matched with AAS. If for this, we need to check cash ledger. In the cash ledger, total debits and credits must be matched with the AAS portal. Sometimes total debits and credits may be excess, maybe shows excess than AAS, because some transactions more than 10 lakh will be mandatorily reported by the bank to the department. If transactions is less than 10 lakh, then they may not, then they don't have mandatory to report in AAS portal. So if cash deposits are, but some bankers are reporting even if it is less than 10 lakhs, but some banks are reporting to the department. So be cautious on that part. While filing the return, cash withdrawal subjected to TDS under section 184N, this must be taken for scrutiny if high value of withdrawals has been taken from the current account or savings account, as the case may be. And matching the financials with Form 26AS. As I said earlier, Form 26AS is a consolidated tax statement for TDS and TCS credits. Also, refund and demand, if any, has been reported in the Form 26AS. Every TDS and TCS credit must be matched with our income, because if a person deducts a TDS, that will are part of income. That income need to be reported, because in the ITR, I'll show it in the next slide. In the ITR, we have separate schedule to report TDS and TCS claim schedule. For we need to offer each head-wise income need to be offered, and section-wise also need to be offered. And this gross amount must be matched with, as I said, this if amount is reflected in Form 26AS, that amount must be matched with our financial statement, even though if it is income is offered under different heads. Say, for example, if interest income is received, it has been offered under other income. It is not a part of business income for associates other than who is engaged in financial business. Income spread across multiple months. Even say, for example, 1 month we are receiving interest income, other month maybe we are not receiving, subsequent month also we are receiving. Even if it is unmatched, we need to offer proper reconciliation. And even though taxpayer follows cash or accrual method of accounting, we need to mandatorily have proper reconciliation of tax credits and total income offered to the department. Because, as I said earlier, in the ITR form, the head of income along with TDS deduction have been offered to tax need to be reported. It has been given here. If you can see that this have been taken from the ITR form. The details of tax deducted at source on income must be matched with these schedules. In the column number 2, TDS credits relating to self or other persons. Other persons means in case any deductor has reported inadvertently, then we can give that credit to respective person after information is given to the deductor. After information given to the deductor need to file need to correct his TDS statement. After that, that correct person can take credits. Otherwise, correct person cannot take credit. And we need to give our PAN or Aadhaar of other persons. Also, we need to give the TAN of the deductor. TAN of the deductor will be available with the AS, also available in the 26 As also. And section under which TDS is deducted also need to be after. Say, for example, whether whether TDS has been deducted under section 194C or 194J or 194N, as the case may be. That proper section name also need to be given. In column number 5 and 6, we need to report unclaimed brought forward TDS claimed during the current financial year. Say, for example, in the financial year 23-24, we did not claim the total TDS reductions, and it has been carried forward to subsequent years. In the financial year 24-25, we have received that income and accounted that income. Then that will be reported in the this best example is for construction contracts. We need to offer income at the time of completion of the contract. Generally, construction contractors will offer the income to the income tax department based on percentage of completion method. If any advance received by them, that will be subjected to TDS under section 194C. If TDS is deducted, then that contractor need to offer his income, or otherwise he need to carry forward as given the column number 13. So in the column number 13, you see TDS credit being carried forward. We can carry forward the total TDS credit to the subsequent years. Say, for example, in the financial year 24-25, we didn't offer as income because of some restrictions. As I said in the earlier example, because for construction contracts, they need to offer income only on the basis of percentage of completion method. So at that time, they need to report in the column number 13. So current year, we will not going to adjust that TDS credit with our tax liability. Our refund will not be given for that TDS portion. And in the column number 19, we need to report how much amount of TDS we are going to claim in our own hands, and how much TDS credits we are giving to other persons. That is wrongly reported by the deductor. That is given the rule 32 BA2 of income tax rules. And for other person deductions, we need to report income along with TDS. Income means that grossed up amount along with the PAN or Aadhaar number of the other person. And in the column number 11 and 12, we need to report that total gross amount for the TDS credit. Say, for example, if TDS is deducted under section 194J, 10% of TDS amount has been reported in column number. In the column number, the section is need to be given the 4A, and the total TDS amounts has been claimed will be reported in column number 9. And the gross amount, that is, say, for example, 1 lakh is total income, 10% TDS has been deducted under section 184J. Then this will reported under column number 4A, that is 194J need to be reported in column number 4A. And in column number 9, the total amount of rupees 1 lakh need to be reported, not 90,000. So 1 lakh will be reported in column number 9. And in column number 11, 10,000 need to be reported. So column number 11, 1 lakh will be reported. In the column number 9, 10,000 need to be reported. So head of income also we need to report whether we are offering that income as business income or other income, income from other sources, or capital gain or salary, as the case may be. under what head of total 5 heads of income is given. So in under 5 heads, in which head we are offering it as income, that need to be reported. This is not applicable for 194N because 194N is for cash withdrawal TDS section. So if cash has been withdrawn more than prescribed limit, then TDS has been deducted. For that alone, we don't need to report head of income. And matching ITR with tax audit report. This is very much crucial because if any misreporting can lead to proposed adjustment that will be directly generated by the centralized processing center. So we need to be cautious while preparing ITR. We need to ensure that every item should be matched with tax audit report. And first thing is in the class number 13F tax audit report, the method of account need to be given, whether assessee is following cash basis method of accounting or mercantile system of method of accounting. This need to be reported in the ITR form also. So we need to be cautious that this has been selected correctly. And ICDS adjustments. ICDS means Income Computation Disclosure Standard. Total, there are 10 ICDS has been provided by the income tax. And if any adjustments has been reported, say for example, in case of borrowing cards, any adjustments have been made, then that adjustment amount must be reported in ITR also. This need to be reported in other information of the ITR part A of other information. Thus, that need to be reported in ITR also. After employees' contributions towards PF and ESI, this will be covered in the class number 20B of tax audit report. This in the tax audit report, we need to give detailed manner, such as how much amount received from the employee and date of deposit, due date of deposit, and total amount of deposit. In case of any disallowance, that is also need to be reported in the class 20B. That disallowance must be matched with the ITR, must be matched with the ITR serial number 6 of other information, because generally other information part is not applicable to all assessees, but if assessee is subject to tax audit, then other information part is mandatorily applicable to that assessee. So any mismatch between these figures, then CPC will automatically issue the proposed adjustment notice under section 143(1)(a). If we are not responding to that proposed adjustment issued by the CPC, then this will automatically added to our income of total income returned. And depreciation and asset details. We need to, in the class 18 of tax audit report, tax auditor need to report total amount of depreciation along with date of addition, date of deletion, and whether it is less than 180 days or more than 180 days for claiming depreciation purpose, tax auditor need to be reported. That report must be matched with scheduled depreciation in the ITR. Because if it is not matched with the ITR, then definitely we will get a scrutiny notice or proposed adjustments, because in the tax audit, because in the department view, tax auditor has been correctly reported, maybe assessee has reported due to some mistakes. So initially they will issue proposed adjustment notice. Say for example, tax auditor has reported total 10 lakh depreciation, but assessee has claimed 12 lakh depreciation. That 2 lakh depreciation will be disallowed while processing the while CPC processing the return of the assessee. Before that, CPC will issue 143(1)(a) proposed adjustment notice. After that only they can proceed with the proposed adjustment. And in the class 37(1), class 21A of tax audit report, inadmissible expenses such as personal expenses debited to profit and loss account or capital expenses debited to profit and loss account. Capital account transactions, which means generally capital account transactions, that is fixed assets addition, whether it is for purchased for long term, so that need to be reported. Capital account transaction generally need to be balance sheet item that will not debited to profit and loss account. If it is debited to profit and loss account, then the tax auditor must be shown in the class 21A. And any penalty has been levied for violating the law or offense, then these all must be reported in the tax audit report. Also, this will need to be reported in the ITR 7. ITR 7, serial number 7 of other information. Because ITR have more column to report all disallowance. In the tax audit report, the specific disallowance only need to be reported. So assessee's responsibility is to ensure that all the disallowance has been correctly reported in the income tax return. Otherwise, this will create a problem if the income tax department will take scrutiny assessment. And capital expenditure, as I said earlier, class 21A1 covers capital expenditure. This need to be disallowed if books of accounts is not correct. Then tax auditor reports, tax auditor can inform the assessee to correct the books of accounts before filing return. If assessee is objects to correct the books, then only this can be reported in the class 21A1 of tax audit report. Though if it is reported in tax audit report, then it must be reported in ITR 7 also. Sorry, ITR serial number 7 of other information also. And TDS for non-compliance. For TDS for non-compliance, say for example, if we are need to deduct TDS for some expenses, but we didn't deduct TDS, then it must be reported under 40A1 or 1A as the case may be. 40A1 is for amount payments to non-resident. 40A1 is for payments to residents other than salary. And this must be matched with the serial number 8 and serial number 9 of other information in the ITR. Otherwise, for this class, directly income tax department issues proposed adjustment notices why this amount has not been disallowed in your total expenses. Even though we are giving proper reply, they will not consider the reply. They can initiate the proposed adjustments, and we need to pay that amount of tax, or we have getting reduced refund amount. So this class need to be properly reported. And cash expenses under section 40A3. If cash payments exceeds more than 10,000 for a single day to a single person per single invoice, then this need to be reported in class 21D of tax audit report. Also, this need to be get reported in serial number 9 of other information. That is disallowance under section 40A3. They have given specifically given this column. So we need to report that here. And section 43B items. This is unpaid statutory dues or interest on loans to scheduled bank or nationalized bank reported in TAR must be reported in serial number 11 of other information. In ITR, ITR 3, ITR 5 and ITR 6, 7 have other information. So we need to report in the other information for the all the disallowances. If not reported, then as I said earlier, CPC, Centralized Processing Center, can make automatic addition to our return of income. And details of turnover. This is most crucial class in tax audit report. In the class 40, tax auditor need to report gross profit, total turnover, net profit of the C, and stock turnover ratio also need to be reported. This must be matched with the ITR. In the ITR, we have manufacturing and trading account, and profit and loss account, trading and profit and loss account, and balance sheet. This must be, gross profit must be matched with manufacturing account, and net profit must be matched with trading and profit and loss account. So if there is any discrepancy, this may lead to scrutiny notices from the department, or sometimes proposed adjustments can also be issued for stating that why there has been difference has been reported. And disallowance not fully reported in TAR, but it is mandated to report in ITR, because TAR and this is income tax debited to P&L, which means in tax audit report, income tax, say for example, any advance tax or income tax relating to earlier assessment years, or self-assessment tax, if debited to P&L account, then it must not be reported in tax audit report, because this is specifically covered under section 40A2. For 40A2, there is no specific clause for reporting expenses. If we are reporting in personal expenses, and in the ITR we are reporting it as 40A2 disallowance, then assessee definitely get income tax notice, the mismatch between tax audit report and your ITR computation. So we are going to disallow the amount as stated in the tax audit report. This notice will definitely issued by the department. This is a proposed adjustment notice. And provision for doubtful debts not allowable under section 36, which means provision generally not allowable for all assessees. Provision for doubtful debts is allowed only for bankers. So if assessees recognize the provision for doubtful debt, then this need to be disallowed in ITR only, because tax audit report does not have specific clause to report this provision for doubtful debts. And any other disallowance in ITR form, we can see under section 36, we can see any other disallowance that is not specifically given in section 36. So this section disallowance is not specifically given in the tax audit report, same as section 37 general deductions. This is also not specifically given in the tax audit report. So this need not be directly reported in the tax audit report, but it must be reported in the ITR while computing our total income. This is a most crucial class. This is class number 44 of tax audit report. Class number 44 of tax audit report covers GST registration, GST expenditure, and relating to payments relating to GST expenses, payment relating to other than GST expenses. That is, each bifurcation of expenses need to be given as follows. Total amount of expenditure incurred during the year need to be given, and expenditure in respect of entities registered under GST also need to be given in the class 44 of tax audit report. Also, expenditure relating to entities not registered under GST also need to be given in the class 44. Any misreporting or in case of any unregistered unregistered person purchase, reporting is high, the department may issue income tax scrutiny notice. I'll show you the one of the scrutiny notice issued by the department for showing high value in the column number C, that is expenditure in respect of entities not registered under GST. This is the notice. There are total 10 number of information has been sought by the department. This is one of the class that covers specifically covers for item wise expenditure for class 44. We need to we have given name and address of the each party, whether the party is registered or unregistered. We need to report the same, and PAN and the email ID, description of goods, what good we have purchased, we need to report it here, and the amount of expenditure, total expenditure, and head in which expenditure is claimed, whether it is purchase or direct expenses or indirect expenses. We need to give proper bifurcation for class 44, because once the notice is received, we need to mandatorily comply to the department. And this is a part B of that notice. For each party of above, for each payment, provide by the following details. they have asked the name of the party, description of goods purchased, amount of expenditure, mode of payment to unregistered purchases, whether we have paid through cash or account mode, electronic mode, and date of payment, where we have point of origin of goods, which means where we have purchased the goods, and address of the place of the business where goods are received, that is assessee's address, and date of delivery, name and address and PAN of the transporter, because if goods, then transport definitely gets involved. Transport charges paid. These details, this clear bifurcation detail need to be given in the notice, because in one of our cases we have reported a high value unregistered purchases, so they have asked like this. And in that one sample bill also they have asked for the same party list. Say for example, if party list is 200, then we need to submit 200 list of sample bills, and ledger for the each of the above parties we have given. And for non-cash payments such as electronic mode, bank statement we have given, and for cash payments we have given cash ledger along with that parties ledger we need to be given. This much of details have been asked for high values reported in unregistered purchases. So please be careful while filling clause 44 in the tax audit report. And matching, the tax auditor need to be reports only specific disallowance in the tax audit report. Not all the disallowance need to be reported in the tax audit report. Only specific disallowance has been reported in the tax audit report, which is in the Form 3CD. The assessee is responsible for reporting the all disallowance. If disallowance attracts, say for example, earlier I said that class 36 any other disallowance and class 37 disallowance and the income tax debited to P&L account need to be mandatorily disclosed by the assessee to report properly. Just a minute. Yeah. And the department expects full reconciliation between TAR disallowance and additional disallowance. So it will reflect the correct computation of total income. If some disallowance has been reported only in TAR and not reported in ITR, then definitely you will get a proposed adjustment notice. And if additional disallowance is not reported, then at the time of scrutiny, we can get why this amount of disallowance has been not reported. Only if it is taken scrutiny, then only the assessing officer will know the additional disallowances. Otherwise, they will not know additional disallowance. And proper and accurate reporting will help to ensure smooth and hassle-free proceedings during any scrutiny assessment. Because if we misreport something at the time of scrutiny assessment, we need to check the all transactions whether it is correct or not. So at the time of filing ITR itself, we can ensure that all the proper disallowance has been reported in the ITR computation. And in the tax audit report, class 8A specifically asks about whether assessee has opted new tax regime or not. We need to exactly given the whether the assessee has opted new tax regime. In the ITR also we need to give the same in the status of filing. So please be careful that whether the assessee has opted section 115 BAC or BAB or BAA for companies, we need to give proper attention on this matter. Generally, for section 115 BAC is available for individuals, which is reduced, which is beneficial tax slab rate for paying income tax. The same case for companies, section 115 BAA is available. Only for domestic companies, they can pay tax at the rate of 22% plus surcharge 10% and 4% of health and education cess. The effective rate of tax would be 25.168% will be comes to. Why it is beneficial? because if assessee is not opted 115BAA, then minimum alternate provisions under section 115JB is applicable to the assessee. If MAT is applicable, then assessee need to file, assessee chartered accountant need to file Form 29B for claiming MAT credits or MAT deductions. Also, if company is opted for 115BAA, some deductions has not be allowed as such as specified business reductions and scientific research reductions and Chapter 6A reductions, except for 80JJA, that is additional employee cost. Generally, these reductions are not allowed for assees. Also, it is very much important to note that if assessee is opted 115BAA, additional depreciation under section 32(1)A will not be allowed. So please be careful that while opting this section, because in the initial years of startup companies, 115BAA is beneficial, because in the initial years, Companies Act profit as per books is higher, and profit as per Income Tax Act is lower because of that depreciation. And as I said earlier, 115BAA is applicable, then MAT is not applicable under section 115JB. If MAT is not applicable, then it is beneficial to the assessee, because under the MAT, assessee need to pay, required to pay tax as per book profit. But if MAT is not available, then assessee can go with the effective tax rate of 25.16%. That is generally for domestic companies, tax rate is 25% plus 4% of health and education cess. That is effectively comes to 26%. If assessee is opted 115BAA, 25.17%, effectively the rate will comes to. The only beneficial thing is in the initial years, assessee as per the profit as per income tax is very much lower because of depreciation. Because as per Companies Act, we can claim depreciation based on number of days used. But as per Income Tax Act, we can claim depreciation as per we have used less than 180 days or more than 90 days. If it is more than 90 days, then the total depreciation as per income tax is so much higher. So the profit as per income tax is completely reduced. So the in the initial years, assessee will may beneficial, because generally this is due to timing differences. This timing difference will match over the period of time. So if assessee is ready to opt 115BAA, and in future the assessee will develop their business by investing in plant and machinery, then assessee can surely go with 115BAA. Otherwise, regular provisions of Income Tax Act is assessee cannot. Once the 115BAA is opted, then option cannot be withdrawn for any assessment years. So while opting for 115BAA, please be careful that assessee is going in future expand their business. Otherwise, this section is not beneficial to the assessee comparatively. And for opting 115BAA, assessee need to file Form 10IC on or before due date of return of income under section 139(1). If assessee is filed after due date of return of income, then that new section claiming will not be available to the assessee. And as I said earlier, if assessee is not opted 115BAA, then assessee need to pay tax as per normal provisions of Income Tax Act or MAT payable as computed under section 115JB need to be mandatorily paid. And this is the general note between AAS and 26 AAS. This is available in the Income Tax Department itself. I have taken from there only. Priority of 26 AAS over AAS. For tax credits, that is TDS and TCS credits, we need to refer 26 AAS, because some deductions due to some portal glitch, it will not reflected in AAS. Even though all the transactions reported under AAS, but some details, if it is not reported, we can relay 26 AAS and take the credit as per Form 26 AAS. And nature of AAS data. Nature of AAS data is the information is available with the department. Maybe information is not available with the department, then we can rely only on the books. Many transactions may also missing or incomplete. Say for example, salary, if TDS is not deducted, expenses, we are paying salary to employees. If TDS is not deducted, then this information is not available with the income tax department. So that need to be mandatorily claimed as expenses by us only. Also, for interest income, not deducted TDS, and this interest income is not reported in 3B. So for interest income, not deducted TDS, we need to offer it as income we have received in so and so income. Like that, some information will not be available with the department. So we need to make sure that voluntary complaints need to be ensured. And the as I said, voluntary complaints, the accurate information need to be given in the ITR. Otherwise, at the time of scrutiny, we may face the consequences that why we haven't reported this income. So the assessing officer will going to add unreported income as unexplained income. There is a possibility. So we need to make sure that proper complaints to the department. And for the tax payments, that is advance tax and self-assessment tax, for the financial year 22-23 and earlier years, we can refer Form 26AS. For advance tax and self-assessment tax, only reflected in Form 26AS. From the financial year 23 and 24 onwards, we can refer to AS only, because 26AS will not going to reflect the advance tax or self-assessment tax details in the Form 26AS. So we need to refer AS for advance tax and self-assessment tax paid during the year. And income tax notices, generally the crux of this webinar is to ensure that proposed adjustments notice will not issue to the assessee. So when the what is proposed adjustment? Proposed adjustment means any variation between the information available with the department and assessee's return of income. So information available with the department is so huge, because department have AAS, Form 26AS, and tax audit report also they have. So if any misreporting may lead to proposed adjustment notice. So especially in tax audit report, if assessee is not reported in income tax return, definitely income tax department will issue a notice, that is proposed adjustment notice. So what are the when the proposed adjustment notice are made, we will going to see. In case of any arithmetical error in the ITR, the CPC can correct the mistake and sometimes process the return, give an intimation order, but sometimes issue that this is a mistake, rectify the same before some time limit has been given for proposed adjustment notice. Generally, the department will give 15 days to correct the errors. And incorrect claim, in case of any incorrect claim that has been apparent from any information in the return, then we need to then the department may issue proposed adjustment notice. And disallowance of loss claimed. If the return is filed after the due date, which means due date, we will discuss later that what are the due dates for upcoming dates. And if the return is filed after the due date, then assessee cannot carry forward their business loss, except loss due to depreciation. That is called unabsorbed depreciation loss. Unabsorbed depreciation loss can only claimed even if filed after the due date. Otherwise, assessee cannot claim general business loss. So if we are filing return of income after due date, we are claiming it as carry forward loss, then CPC will issue proposed adjustment notice that this much of business loss cannot be allowed due to you have filed a return beyond due date. For due date, condonation of delay can be filed, but many times condonation of delay for return of income has been rejected by the AO due to not valid reason. If valid reason, we can file condonation of delay of return. And disallowance of expenditure or increase of income in the tax audit report. Generally, most of the assessees will get this adjustment notice because tax auditor has been reported in the tax audit report that any incorrect reporting will lead to assessee definitely get a notice. So if assees get a notice, we need to prefer an appeal, or otherwise we need to revise the tax audit report. Otherwise, the CPC will always process the return with this proposed adjustments only. And addition of income appearing in Form 26 says, in case of any income that is not, we have taken the TDS credit, but not offered as income, then department will, the CPC will issue a proposed notice stating that why this income is not adding to your total of income. So we need to give response that we have missed this income, so you can add that. So at the after some time, CPC will process the return after adding that income. If not, if TDS credit is not us and that income portion is also not us, then we do not claim the such TDS credits. Otherwise, we will get a notice for the same. And these adjustments, CPC cannot directly process the intimation order. That is, after all adjustments, intimation order will be issued to the assessee under section 143(1), unless otherwise intimation is given to the assessee. That is notice. Proposed notice under section 143A mandatory need to be given before making any adjustments as listed above. And the time limit for filing ITR. Generally, time limit for filing ITR for the companies and assessees, for the assessees who all are subject to tax audit is 31st October. But as per circular number 15/2015 dated 29/10/2025, it has been extended to 10th December, which means for the assessees who all are subject to tax audit, then they need to file income tax return on or before 10th December of 2025. That is next month due date. If not filed, they can file belated return without claiming business loss, if any. And assessee subject to transfer pricing audit, the due date is 30th November only. For transfer pricing audit assessees, due date has not been extended. And for other assessees, due date has been already lapsed. Generally, due date is 31st July. As per circular number 6/2025, the due date has been extended up to 15th September of 2025. The due date has been lapsed. So if assessee is not subjected to tax, audit and having business income, if they have incurred a loss, then they cannot claim loss if return is filed after 15th September 2025. For the this is for the financial year 24-25. For belated return, there is no extension has been given for the belated return. So general due date is 3 months before the end of the assessment year. So the due date is 31st December 2025. If assessee is not filed return before 31st December 2025, then the assessee can file updated return by paying additional 25% of tax if tax liability arises. If return is a loss return, that is, if assessee is already having loss and cannot carry forward loss, if assessee is filed before 15th September, they can claim. Who all are not, I'm talking about assessees who all are not subjected to tax audit. If assessee is having business income and return is not filed up to 15th September, then they can file return up to 31st December, provided if assessee do not have loss. If assessee has loss, then that loss amount can be loss amount must be lapsed. For the assessees who is having business income or other income not filed before 31st December 2025, they can file updated return by paying additional penalty of 25%. If return is a loss return, that is, if we have reported a business loss, then we cannot file updated return. So please file the return before 31st December 2025 if you have loss. And this is the general precaution for filing ITR. Fill the each schedules carefully: schedule balance sheet, schedule profit and loss account, schedule depreciation, or scheduled capital gain, other information for us is mandatory subject to audit. And this will mandatory because the financials also need to be matched with these schedules. Otherwise, at the time of scrutiny, we may face the consequences that we cannot explain to the assessing officer that we have filled wrongly. So this schedule needs to be properly reported. And tax payment verification. We need to ensure that the advance tax has been timely deposited and the self-assessment tax payments reflect correctly in the AS. In the earlier years, the self-assessment tax and advance tax has been reflected in Form 26 AS. From the financial year 23-24 onwards, advance tax and self-assessment tax will be reflected only in AS. So ensure that the advance tax and self-assessment tax has been properly reported and reflected in AS and correctly claimed that. And do not claim the unverified or unmatched TDS credits, because just because it is appearing in the Form 26 AS, we can claim TDS credit. No, if we are claim, then we need to offer it as income. If we didn't offer this as income, but we have claimed the TDS credit, then definitely we will get a proposed adjustment that stating that this income will be added to your total income because we have claimed the TDS credit for that gross amount. And e-verification must be done for the assessees within 30 days from the date of filing. For companies, while submitting the return itself, we need to mandatorily e-verify the same. For other OTP cases, we can e-verify within 30 days from the date of filing. For late filing, avoiding late filing fee, need to assessee need to file return on or before due date, as I have explained in the earlier. Because if not filed within due date, then assessee may face the consequences that he may forgo the business loss, and late filing fee may attract. Late filing fees, if assessee's total income is more than 5,000, more than 5 lakh, then assessee need to pay 5,000, or up to 5 lakh, then assessee need to pay 1,000 rupees as late filing fee. And 234 ABC interest will also applicable if proper advance tax and self-assessment tax has been not deposited timely. So to avoid these much of consequences, ensure that proper filing on or before due date. And generally, in the previous yes, the department will have issued that. Department is not issuing the scam notices. On the name of department, many people's getting notice that you have demand or you have refund. So you need to click that link to get the demand, or you need to click the link to payment this amount of demand to the department. Many assessees getting the scam mails. Do not fall for that scam. Department will never send notice with link. So if you have received link with the link that is in the email, just check the mail ID. It will definitely not from the income tax department. Even if it is in, named as income tax department, please log into income tax portal, check whether you have received the notice in the e-proceedings tab. If not, then you can just ignore that mail. If you're clicking that that spam mail, it will directly take you to through payment link. Many SC has been paid that, say for example, 10,000 demand. So you need to pay 10,000 demand to get released and process your return smoothly. The SC will pay the demand because many SCs don't know this is a scam mail. So please make sure that if you have received any scam notices, just check, log into the income tax portal, check in the e-proceedings tab whether you have received any notices, or complaints portal as the case may be for AS discrepancies. You have received any notices, check that. After that only, whether the notice is real or fake, we can identify the same. And thank you for all for participating in this webinar. If you have any queries or doubts, please contact above number. That is my number. Please contact if you have any queries. Thank you all. Thank you for participating in this webinar. If you have any queries regarding AS, TAs, or 26 AS or tax audit report, please mail to our Zentax team or message that number. Thank you.